Hi, ladies and gentlemen. Welcome to our live webinar with us from Phillip Nova. And today we'll be discussing your guide to the 2025 stock market. What are the trends, opportunities, and strategies? So, what should investors look out for in 2025? The stock market is brimming with possibilities, but also uncertainties. What trends will shape the year ahead? And which regions offer the greatest potential? And how can you position yourself to seize the opportunities? In this webinar, gain a clear view of the forces driving global markets, from key macro trends to regional insights across the US, Japan, China, Hong Kong, Europe, and Southeast Asia. This session will equip you with the knowledge you need to navigate 2025 with confidence, and this is your chance to stay ahead. And in this webinar, we will be covering, giving an overview of the current market. We'll be discussing macro trends shaping the market, the regional market insights for the US, Japan, China, Hong Kong, Europe, and Southeast Asia, the positioning that you should be having in for 2025, and what is our guest speakers' top five favorite plays heading into 2025. About our speaker, who do we have in the studio? He's none other than Danish Lim. He's a senior investment analyst with Phillip Nova. His area of expertise are in equities, equity indices, forex, and commodities. He frequently shares his views and opinions through daily market commentaries that are sent to customers. Danish is also well versed in technical analysis, and his market views and commentary are regularly published in the Business Times, the Lian He Jiaobao, and the Age Singapore. All right, Danish, if you're all set to go, I'm gonna give you sharing rights so you can. Oh, we already see your slides, so you're all set up there. All right, members of the audience, I have one more thing for you to do before I hand the reins over to Danish. If you can hear me loud and clear, just to make sure the sound is all good on your end as well, please type yes in the question box. You can head to your control panel, which you see somewhere on the top right, click the question option and type yes in there so we know you can hear us loud and clear. Okay. All right. So, Danish, if you're all set to go, I'll hand the time over to you. The floor is yours now.
Okay, thank you, Sri. So I'll go ahead and begin with today's webinar. So I hope you guys have your water bottles ready. Today's session, I'll be trying my best to cover almost every major regions of the stock market, including international equity markets like the UK, China, Hong Kong, as well as Singapore and the US. And also, I think it will be good to have your phones nearby so that you can take a picture anytime you want to. So before we proceed, this rough disclaimer. I'd like to highlight that this presentation is intended for general circulation because we do not take into account your specific investment objectives, your financial situation, as well as your particular needs. So this is a rough outline of today's webinar. Again, I'll be going through the current market snapshot, key market trends, different insights for different regional markets, how you should position your portfolio for 2025, and of course, as Sri mentioned, our top 5 favorite plays heading into the new year. So to kick things off, I'm sure you're all well aware of how well the US market has been performing recently. You can see from this chart I provided over here that the S&P 500 is on track for back-to-back 20% annual gains for the first time this century, meaning this, since 1999. And this is because of a lot of reasons. The US economy is still very, very resilient. The Fed is cutting rates, treasury yields are stable, credit spreads are tight, meaning that there's low likelihood of corporate bankruptcy, and there's also a very low probability that a recession will happen. So all these have been supporting equities higher. At the same time, because of the strong market performance, a lot of equity markets are near or at all-time highs. When you compare the valuations of the S&P 500 against the FTSE All World ex-US index, which I've shown on this chart over here, the top graph is the S&P 500's PE ratio. Currently, it's about 25.8, and the median since 2020 is about 21.8. So the current P ratio is a lot higher than the 4-year median. However, if you see the FTSE All World ex-US index, basically an index that excludes US equities, we see that the current P ratio is actually very near the median since 2020. So this means again that it highlights how elevated the US equity market the valuations are right now. However, I like to highlight again that just valuations or high valuations do not mean that bull markets will end. It's very possible that the S&P 500 or the US market can continue to trend higher despite high valuations. What we typically see more often is that we may see a retracement, a minor retracement, maybe to a key support level, and then the S&P 500, for example, may then bounce back and then continue to trend even higher. So valuations alone do not mean that a bull market will end. So, just to give some, view on the economy in the US, the recent CPI reading made markets essentially price in already a 25 basis points rate cut. And just to stress again, the Federal Reserve's interest rate decision, I believe, is on this Thursday at about 3 a.m. So that's something to keep a lookout on. And according to the September dot plot, currently the Fed is projecting about 425 basis points rate cuts next year. And this might change after this Thursday's FOMC meeting. So why is the economy in the US so resilient? Mainly, it's because of very strong consumer spending. You can see over here that this chart I provided, the US economy grew at about 2.8% in the third quarter, and most of it is driven by consumer spending, which contributed about 78% of this GDP growth. And what we also noticed is that despite consumers becoming more thrifty, they were somehow able to continue to stretch their budgets, mainly due to more unique inventions or innovations, such as the buy now pay later schemes. For those of you who are unfamiliar, buy now pay later, typically we also have similar schemes in Singapore. For example, Atome, where you, instead of paying on the spot, you can choose to make a payment, let's say for the next 3 months, over 3 monthly installments. So, this is one reason why consumers, despite being thriftier, were able to continue spending and stretching their budgets. At the same time, businesses have also continued to invest. Capex is still very high despite high interest rates, thanks to strong corporate balance sheets, as well as support from legislation such as the CHIPS Act. More importantly, we have also seen a lot of big tech companies continue to invest in AI, and in our opinion, if rates were to come down, these investments be further accelerated. So this is a rough market snapshot of the top performers in the US ETF market. US ETFs, they saw strong inflows for most of the year. Tech and mega caps led the way in the first half of the year, but very interestingly, in the second half of the year, we saw performance started to broaden out. Small caps, as well as the Invesco S&P 500 Equal Weight ETF, where instead of the normal S&P 500, which is weighted by market cap, this ETF is based on an index which essentially gives all 500 companies an equal weightage. When we saw, small caps and this particular ETF even see greater inflows in the second half of the year, the ETF even entered the top 10 in terms of inflows. At the same time, Bitcoin ETFs also saw tremendous inflows after their approval sometime in March this year. And of course, they also benefited from Bitcoin prices that are currently, last I checked, above $105,000. So in the SG or Singapore side of things, ETFs tracking Singapore REITs, the Lion Phillip S-REIT ETF saw the highest inflows thanks to optimism surrounding rate cuts. This is because REITs tend to benefit from lower interest rates. At the same time, our STI ETF also saw steady inflows because Singapore as a market, we have relatively high dividend yields, and our local banks, the three local banks, DBS, UOB, and OCBC, they performed very well. Uh, of course, other than that, other Asian ETFs such as covering India, China, and C all saw improved fund inflows. On the other hand, Hong Kong ETFs such as the Lion OCBC Hang Seng Tech ETF saw a single-day high in trading turnover sometime in September after the PBOC's stimulus announcement. From a bottom-up perspective, especially in the US market, it may come as a surprise that the best performer in the S&P 500 is not Nvidia. It's not Apple, it's not Alphabet. It's actually a little-known company called Vistra Corporation, and it's actually a power generation company. And what it does is that it actually supplies power to data centers in the US. Therefore, it's rallied by, as you can see, about 303% this year. So the stock price has almost tripled. And the main reason is because it's an AI play due to high demand for power, especially from hyperscalers and cloud service providers, because of the huge amounts of energy that is needed for all the AI applications such as ChatGPT. From a sector perspective, obviously, tech has also led for most of the year. Communication services and infotech are in the top three, but quite interestingly, financials are actually the second best performing, and this is quite contrary to expectations. Coming to this year, a lot of people were actually pretty bearish on financials and banks because they expected lower interest rates to weigh on the sector. However, financials and banks actually benefited from higher non-interest income. And we talk about non-interest income, this refers to things like investment banking, wealth management, insurance, trading fees, and other things of that nature. Other than that, financials also benefited because of optimism from Trump's potential tax cuts, as well as the second half rotation that I mentioned previously. On the Singapore side of things, top performer is Yang Zijiang, which is a Chinese shipbuilder. And like I mentioned, Singapore banks remain very robust thanks to improved non-interest income. Other than that, we also have the aviation food caterer SATS, who benefited from aviation recovery in Asia, as well as a improvement in cargo volume. And cargo volume was actually saw tailwinds because of a disruption to the sea freights due to the Red Sea crisis. So now moving on to the next section, let's talk about some of the key macro trends that we expect to shape markets next year. Firstly, central banks are currently moving towards lower rates. As you can see, a lot of major central banks across the world are actually have started to cut interest rates. Of course, you have your exceptions such as the Bank of Japan and the People's Bank of China, but we believe that most of the major central banks are on a rate cutting path that should continue. However, how fast or how quickly they cut rates will be very dependent on domestic policies as well as the US tariffs. Something to highlight here again is that following Trump's election victory, we actually saw markets start to price in a higher terminal rate. And we say terminal rate, it essentially refers to where the markets believe that the Federal Reserve interest rates will settle at. And essentially, this led to an increase in yields because markets expect Trump's policies to add to inflation. Other than that, of course, we also believe that geopolitics remain a very important key concern, especially with regards to US-China trade tensions, trade and as well as Trump's tariffs. So, according to our research as well, typically during a rate cut cycle, historical data shows that when the Fed starts to cut interest rates, this could actually be supportive of stocks. You can see in this chart I provided over here that during an average non-recessionary Fed cut, the S&P 500, according to data back to 1971, have an average annualized return of about 25.2% during non-recession periods, compared to about 11% in a recessionary period. Other than that, for the Russell 2000, they have an annualized return of about 19.6% during a non-recessionary period, compared to 16.5% during a recessionary period. So again, if the U.S. economy were to see a soft landing, so there's no recession, and if the Fed continues to cut interest rates, U.S. equities will most likely continue to outperform. Of course, when we talk about Trump 2.0, as I've mentioned, a lot of his policies, including tax cuts, higher tariffs, as well as deregulation, have the potential to contribute and add to inflation. According to a recent estimate by the Budget Lab at Yale, this all his tariffs is estimated to increase consumer prices by about 1.4 to 5.1%, which is equivalent to about $1,900 to $7,600 in terms of disposable income for the average US household. More importantly as well, some of the countries with a huge trade surplus with the US, meaning that they export the most amount of goods to the US, we believe are at the greatest risk of tariffs. And our data from Bloomberg shows that Mexico, Canada, and China have essentially the biggest trade deficit to the US. They export the most goods to the US, and in combined they account for about 40% of US trade. And this puts them at the greatest risk of more tariffs because Trump has said that his main focus for tariffs is to reduce the deficit between his trading partners, meaning he wants to import lesser. So, taking all that into consideration, markets right now, or the consensus is that interest rates probably need to be kept above the neutral rate of 3.5%. And when we talk about the neutral rate, this refers to an interest rate level that is neither too accommodative or too restrictive. Essentially, a level that will help inflation remain steady. Therefore, what this means is that, if Trump's policies become inflationary, the Federal Reserve could see a premature end to its easing cycle. They may stop its rate cuts earlier than expected, and this will definitely be bearish for the stock market. So it's something to look forward to heading into 2025. But until then, as I've mentioned, the US economy is still very, very resilient heading into next year. So let's move on to our regional market insights. We're also providing some index targets in case some of you are futures traders or you guys just want to know how we see different countries stock market going into 2025. So this is a rough table that we provided. Some of the macro themes to take note of into next year. As I've mentioned as well, a lot of central banks across the globe have been cutting interest rates, and this is because inflation is generally on the downtrend. However, as we've seen in the news recently as well, geopolitical tensions is still very, very persistent. On the market side of things, we've seen very strong equity performance this year. This has led to concentration risk, meaning, especially in mega caps, meaning that some of the best performing stocks or equities are actually in big caps or big tech. At the same time, we also see gold prices are at all-time highs, most likely due to persistent geopolitical tensions. So I will cover the remaining of these macro themes as we move on with the rest of this presentation. So this is a table that we provided. It covers most of our main investment considerations, as well as index targets in 2025. And do feel free to take a photo. But if you are unable to, don't worry because I'll show this again towards the end of this presentation. So, starting off with US equities, as I've mentioned, US equities have been supported by a resilient economy cooling inflation, AI enthusiasm, as well as anticipation of significant monetary easing. And what happened across in US equities is that when inflation started to fall and when the markets started to price in what we call Goldilocks rate cuts, essentially rate cuts in a soft landing, this resulted in what we call also an equity multiple expansion, which is where the P ratio started to expand. And eventually, what we saw in the second half of this year is that this multiple expansion spilled over to other sectors such as small caps, the Russell 2000 and the S&P 500 equal weighted index. Again, for most of the year, we've seen mega caps start to lead the market. When you compare the P ratio for the equal weighted S&P 500 against the S&P 500 itself, we see that the spread or the difference in P ratios is about 1.8 standard deviations from the average spread over the 5 years. Now that sounds probably a little bit complicated, but essentially what this means is that the difference in valuations or P ratio between the equal weighted index and the S&P 500 is almost at the highest it's been over the past 5 years. Essentially, mega caps in the S&P 500 are being valued well above the equal weighted S&P 500. So why have mega caps led the market? And one reason that some investors may have forgotten or failed to take notice is that this is because mega caps actually saw an earlier earnings recovery. You can see in this chart I provided way back in the fourth quarter of 2022, the Magnificent Seven, or a good indicator of mega caps in the US, actually started to see a tremendous recovery in their earnings growth, and this is well before the rest of the S&P 500. So moving forward, we expect this earnings growth gap to eventually close. You can see that the gap is starting to close, they're starting to converge with each other. And what this means is that this will also potentially close the valuation gap. Therefore, we expect this earnings recovery, especially in the XMAX 7 or the S&P 493, to see an earnings recovery as well. The recovery will broaden to the rest of the index other than the Magnificent 7. And as interest rates come down, we believe that this gap in multiples should start to normalize as well. Therefore, we anticipate a more inclusive rally in 2025. The Magnificent Seven accounted for about 63% of the S&P 500 returns last year. However, this year it's dropped down to about 47%, and for next year, we believe this percentage will continue to drop. So, heading into 2025, we anticipate a broadening beyond our usual tech giants. We believe, we'll see a continuation of the US rotation trade, which we saw in the second half of this year, and we expect more cyclical companies as well as small cap companies to catch up to the Magnificent Seven. So this is a rough figure I provided, which essentially captures the movements of all 11 S&P 500 sectors across the past 3 months. And you can see that it's forming quite a pretty nice shape of a rotation. You can see in the upper quadrant over here, which essentially shows us which sectors have been leading the performance, meaning that they are beating the S&P 500 and that momentum is going up. Sectors that have been leading the market are the consumer discretionary sector, the financial sector, industrial sector, as well as the communication services sector. On the other hand, sectors that are improving, meaning that they are still lagging the S&P 500, but momentum is going up. They're starting to see improved performance. The only improving sector is the energy sector. On the other hand, momentum has been going down in the utilities and the real estate sector. On the other hand, the worst performing sectors, we see the tech sector, the staples sector, material sector, and right at the bottom over here, you can see that healthcare is by far the worst performing sector. So for our outlook on the individual sectors, firstly, we are pretty positive on industrials, energy, and materials because we believe that they will benefit from a decline in interest rates. With lower interest rates, the cost of capital and the cost of borrowing will drop as well, and this will benefit industrials, energy, and materials the most because most of their business operations revolve around very capital intensive expenditures. For example, we have United Airlines, which is one of the top performers in the industrial sector. It's an airline company, and most of their expenditures are very high because they have to buy a plane from some, for example, Boeing or Airbus, and planes, of course, they don't cost a lot. Other than that, we also have energy companies like Targa Resources, and these companies, especially for energy companies, their expenses are also very capital intensive. Lastly, we have more of the more materials companies. They are very cyclical companies. For example, the Packaging Corp of America. They specialize in e-commerce packaging, and they are very cyclical because if the economy does well, e-commerce demand will be high, and therefore demand for their packaging services will increase as well. We're also very positive on financials because, as I've mentioned previously, they are one of the biggest beneficiaries from Trump 2.0. And with the economy doing well and interest rates coming down, we should see improved loan demand. Businesses and consumers like us, with interest rates coming down, may start to take up more loans, and this will benefit banks. We can also see a more favorable yield curve, meaning that the yield curve may re-steepen where the short-term rates are lower than the long-term rates, and this will also benefit banks because most of their short-term borrowings are short-term in the form of deposits, and they also tend to lend long-term. Most of the loans that they make are typically paid over 10 to 20 years, while most of their borrowings are typically deposits and very short-term, usually 1 or less than 1 year. And with the economy doing well, M&A, IPO activity should improve and increase, as well as, as I've mentioned, banks are also benefiting from higher non-interest income. So these are the best performing companies in the financial sector this year as well. Lastly, we are also very positive on utilities and real estate. These two sectors, they typically refer to them as bond proxies because they typically function quite similar to bonds because they provide stable cash flows through the form of dividends. And typically, when interest rates come down, these two sectors tend to benefit the most. Of course, in this sector, we have Vistra Corporation, which I mentioned, which provides power to data centers. Another company who does something similar is Constellation Energy. It's up over 100% year to date. And in the real estate sector, we have data center REITs such as Digital Realty Trust, as well as other real estate related companies. On the other hand, for the consumer and healthcare sector, we are pretty neutral to bearish. For the consumer sector, we believe it could improve, especially with inflation coming down. Household purchasing power may increase due to lower inflation. However, a lot depends on the economy as well as how price sensitive consumers are. If consumers are still price sensitive and the economy is starting to slow down, in this scenario, staples as well as non-discretionary sector will outperform. And these are some of the top performers for the respective sector as well. Lastly, for the healthcare sector, it's perhaps the sector that we're most bearish on, simply due to the fact of how unpredictable the sector is. So for the healthcare sector, they tend to have a lot of new drugs in their pipeline, but the difficulty in actually analyzing the healthcare sector comes when it's difficult to predict whether certain drugs, whether they will pass or whether they'll gain approval at different stages of a clinical trial. So again, within the healthcare sector, there's a lot of winners and losers. One bright spot is in the weight loss drugs segment. I'm not sure if any of you have heard of Ozempic. It's a very popular weight loss drug in the market recently, and Eli Lilly is actually one of the companies which produces such weight loss drugs. Other than that, there's also a room, an element of policy uncertainty. Trump's appointment of RFK is expected to weigh on the healthcare industry. So what about tech? For tech, we see opportunities beyond semiconductors, and we actually believe that there's a wide and very, very broad set of AI beneficiaries. It's not just limited to semiconductors. Uh, Therefore, we have, compiled. Uh, Before that, we do have an image over here of how the AI ecosystem works at a glance. So the AI ecosystem is benefiting from very, very high capex from hyperscalers and cloud service providers, and this will benefit all these different segments. So how do you read this image I provided? At the very top, we have developers of AI tools, for example, ChatGPT and OpenAI. We have end investors, end users like us, for example, when we use ChatGPT, and we have investors. It could be institutional investors, private investors, and then we have the providers of these AI tools, for example, Microsoft, Amazon, Google. And then moving forward, in order for AI to function, it needs power, it needs data centers to store the data, which trains the AI models, and for data centers to function, it needs power. Lastly, for the servers and the AI models to work themselves, they need different types of semiconductor chips. Semiconductors are not just limited to advanced GPUs like NVIDIA. There's a lot of different types of chips. For example, we have memory chips. We also have what is more lesser known, commodity chips. There's a company in the US called Texas Instruments. You may have heard them, and the chips they tend to produce for more commodity like purposes. For Texas Instruments, the chips they produce are used in calculators and other things of that nature. And then that we have chip production, foundries such as TSMC, and other than that we also have companies which provide these foundries with the equipment to actually make those chips themselves. So it's a very wide set of companies that can benefit from AI. And I've painstakingly compiled a table of all the different AI beneficiaries in all the different sub-segments. For example, for power, we have independent power producers such as the company I mentioned previously, Vistra Corporation and Constellation Energy. And for semiconductor chips, we have advanced GPUs such as NVIDIA, AMD, Marvell, Broadcom. So this table essentially summarizes some of the companies that are located in each individual subsegments in the entire AI ecosystem. So feel free to take a photo if you guys need. But do not worry because I will be sharing this picture again towards the end of this presentation. So now let's move outside of the US. Uh, from a global perspective, currently the US is still outperforming most developed markets. However, we believe that Fed rate cuts may start to allow other central banks, especially Asian central banks like Singapore, to start cutting interest rates because they can do so without depreciating their currency against the US dollar. And from a global perspective, again, inflation revival is a very big risk in 2025. So on a global scale, we see actually that most markets are actually performing better than they did in 2016 after the recent Trump election. Despite tariff threats, the US largest import markets, Mexico, Canada, and China, have performed better than they did in 2016. And one reason we think is because perception has changed a lot from back then in 2016. Back then, investors and markets viewed him as a source of volatility and uncertainty. However, now if you look at market headlines in the news, he's essentially being viewed as a catalyst for equity market growth as well as growth in the US economy. So a lot has changed from 2016. So let's move on to China and Hong Kong equities. this is also probably a topic that excites a lot of people, given the you know the volume of news that we read every day regarding the Chinese equity markets. So, for those of you who haven't kept track, the recent earnings season, especially for the biggest, Chinese tech giants, actually was quite disappointing. You can see in this table I provided in the bottom right, showing how Chinese tech giants such as Baidu, AI Cloud, Alibaba Cloud Intelligence, how their cloud units, their earnings growth was actually a lot slower than their US peers. You can see in the third quarter for Baidu, it was 11%. For Alibaba, it was 7%. And this is well below Microsoft Azure at 33 and AWS at 19%. Other than that, some of the leading internet names such as Tencent, Alibaba, JD.com, and Baidu, their sales or their revenue have consistently come in line with estimates or below forecasts. You can see that this graph essentially shows us how much revenue is beating estimates. So back in 2016 and 2020, all the leading internet names which I mentioned tends typically beats estimates by a pretty large margin. But more recently in 2024, we see that it's been unable to beat estimates by quite a wide margin. So, taking all this into account, if their access to advanced chips is further restricted by the US, their performance divergence with the US could be further exacerbated. So why is this happening? Why has the Chinese tech giants been underperforming? And to do so, let's take it step by step and slowly explain China's economic story. So China has historically relied on two primary growth engines. Firstly, they simply became what we typically call the world's factory. They manufacture cheap exports and then essentially export it throughout the entire world, while at the same time leveraging their relatively cheap labor force at that time. Afterwards, they then moved on to a debt-driven expansion of domestic infrastructure. They, companies started to accumulate debt and then use that debt to build more houses, more roads, more rails, and more airports. So all these serve to drive economic growth at least over the past few years. However, right now, labor has become more expensive due to a rising middle class in China. And because labor is becoming more expensive, some youths have found it difficult to get a job, and at the same time the government is also starting to crack down on how much leverage companies have, starting with their three red lines back in 2016. So now, right now, China is actually struggling to move on to a third growth engine, which is domestic consumption. Now, the US domestic consumption makes up about 70 to 80% of GDP growth, but in China, it's only about 50 to 60%. So there's a lot of reason why China's domestic consumption is lagging behind the US. Their economy is being hampered by a property crisis as well as external pressures. At the same time, consumer and businesses are spending less, they are saving more. Therefore, because they are spending less and they're saving more, corporate revenue is lower as well because of lower consumer demand. And with lower corporate revenue, this results in a cycle where lower revenues will result in job cuts, and job cuts will result in less income for consumers. And less income from consumers will result in lower spending. And all these result in a cycle of economic stagnation. Again, their CPI readings or CPI results has barely been above zero for the past 2 years. And the real risk, or one of my biggest risks with China or Hong Kong, is the risk of what we call Japanification or a balance sheet recession. And this is a very unique scenario where households, businesses, and consumers, rather than continue to spend, despite interest rates being very low, or in Japan's case, interest rates were at zero or below zero, households and consumers still refuse to spend Instead, they focused on saving up money and then using it to pay off debt. So because of this refusal to spend, monetary policy doesn't work, and this leads to economic stagnation. So this is one, a very real risk, at least with regards to China. And currently, China can also be seen as a two-speed economy. You can see in the box or the graph I provided in the right, retail sales data is actually below the pre-pandemic, and this again tells us that domestic consumption is still very, very poor. On the other hand, manufacturing continues to outperform. Industrial production is above the pre-pandemic trend. And one reason could be due to companies front-loading their orders ahead of US tariffs next year. But again, this is not sustainable. And you can see as other data shows that for most of this year, the export sector in China performed very, very well. But heading into 2025, the risk of US tariffs may weigh on this export sector after it contributed to about 25% of GDP growth. At the same time, their strong export sector actually resulted in other countries such as the US and the EU looking to somehow stop the inflow of Chinese goods. And more recently as well, the government has unleashed some stimulus, and more recently, some of their top leaders actually announced a shift to a looser monetary policy stance, at least for the first time since 2011. And what this means is that they could lower the reserve requirement ratio, which essentially refers to how much reserves banks have. If banks are required to hold less reserves, this means that they can go out and spend more, they can invest more in the economy, and this will help economic growth. Of course, some other things that officials mention will be that they want to stabilize the property market. They also want to embrace moderately loose monetary policy and also adopt a more proactive fiscal policy. And this is very big, at least for last week, because it was a big change from their prudent monetary policy, which they adopted since 2011. You can see for the years of 2011 to 2024, their monetary policy stance was prudent. And this is because of a rising inflation in China. However, towards the end of last week, on Friday, we see that the CSI 300 or China and Hong Kong stock markets actually dropped by quite a large amount, and this is because of a lack of surprise announcements and details after the CEWC. CEWC is the China Economic Work Conference. So policymakers, they didn't really meet markets expectations, which were raised after the shift in monetary policy stance. And so right now, Chinese equities, I think today they are in the red as well. And this is also because up to March 2025, there will be an absence of very big or major catalysts until the National People's Conference, which will happen in March 2025. And this is typically where officials will set the annual GDP growth target. So there are a lot of reasons on why they're holding back more stimulus. One reason could be due to them not wanting to see capital flight, because if the gap between Chinese interest rates and elsewhere, for example, the US becomes wider, if China cuts interest rates and the gap increases, there's a risk that investors may flock, for example, to US assets instead. Of course, the government has also warned against welfareism, so they have been really pretty hesitant to hand out, cash to consumers, which is typically what we see in US and sometimes in Singapore as well. Other than that, um, there's also the fact that if the company were to spend more fiscally and increase the deficit, this actually clashes with what I mentioned is one of their priorities, which is to have a deleveraging in the economy, especially in a lot of the property sector as well, because of the debt that's been accumulated in a lot of companies in the previous few years. So moving forward, for China, we actually remain pretty neutral. Our outlook is pretty cloudy, but we do see some scope for outperformance. We expect monetary policy to remain accommodative. Fiscal policy, on the other hand, will most likely remain supportive. Most likely, the government will resort to programs like trade-in subsidies. Earlier this year, the government had a program where if you trade in older vehicles, you will receive a subsidy for your next EV, electric vehicle purchase. Other than that, there's also more room for the government to increase their budget deficit, at least above the traditional 3% of GDP. And I think just a few hours ago, the government actually announced that their target for the deficit will be 4% of GDP. And this means that they want to spend more in order to boost the economy. And again, it bears to highlight that their current deficit is still well below the US. The US, increased their deficit to 13% during the pandemic, and right now it's only at 3%. So that shows the difference, and in fiscal stimulus that China is lacking. So in our view as well, a very sustained equity 2025 rebound will require and boost in domestic consumption. It's the third growth engine which I mentioned, and this is very important, especially to offset some of the pressure from trade tariffs on Chinese exports. This will require not only monetary easing but also fiscal stimulus. In 2025, we expect policy to remain accommodative, and at the same time, the Fed rate cuts will provide the PBOC with more room to maneuver. However, there is a limit to how much they can lower rates. The lowest they can go is zero, unless they want to adopt Japan's unique policy of negative interest rates. So there is limited room. Therefore, fiscal policy or fiscal stimulus is all the more important. And really, for China, we recommend having a patient approach. So, in view of all the things we mentioned, we favor onshore A shares. For those who are unaware, A shares are essentially domestic shares, domestic Chinese shares that are listed in China rather than Hong Kong. And one of their biggest benefits is that they are protected against geopolitical or trade risks because a majority of their revenue comes from China itself instead of overseas. And at the same time, as I mentioned, we'll suggest staying patient, at least until we see tangible evidence of a sustained recovery. There are, however, small pockets of opportunities, such as in automation, EVs, software, renewable energy, and other things of that nature. So for China and Hong Kong, this is a table which summarizes our outlook. Again, we are neutral on mainland China and Hong Kong shares, but we focus on domestic A shares because they are more, protected from geopolitical and trade risks. At the same time, dividend plays and dividend names will be supported by recent regulatory initiatives. There's recent regulations that are essentially forcing or encouraging companies to increase the frequency of their dividend payouts as well as the amounts of dividends that they're paying out. And at the same time, small caps, consumer, tech, and property names will most likely be the biggest beneficiaries if fiscal stimulus meets expectations. And one possible way to tap into this opportunity will be through the CSI 1000 ETF. It's an ETF which is traded on SGX. For investors who are interested in the A-share market, there is a Phillip China Universal MSCI China A50 ETF. And we also have, the dividend ETF as well as the China Leaders ETF. Something to highlight about the OCBC, Lion OCBC China Leaders ETF, is that it's a pretty unique ETF in that it excludes all the US listed ADRs, meaning that, they exclude companies which, for example, Alibaba and Tencent, companies that have an overseas listing. So it's something to highlight as well. What about outside China in Asia? In Asia ex China. And these are some of our biggest macro themes for Japan. And when I talk about Japan, um, I tend to see it as that the economy of Japan is actually ahead of China. This is because, for those of you who may not know, China actually underwent what we call their lost decades. They had about 30 years or so of suffering from deflation and economic stagnation. And more recently, we are finally seeing them, inflation starting to rise in Japan. Other than that, uh, so what will determine the future direction for Japan is whether wage growth will keep up with inflation. Recently, the latest data shows that base salaries actually increased the largest in over 30 years. Some of their major labor unions as well have secured over 5% wage hikes in 2024 and possibly more moving forward. At the same time, we're also seeing major corporate reforms. The number of activist investors in the US or in Japan is actually an all-time high. In 2024, as of December, it's at 146 activist investments. It's way, way, way higher than the three activist investment in 2011. And all these activist investors resulted in a record high investment value, which is close to 1.2 trillion yen. Other than that, because of all these, corporate reforms in Japan, we are seeing a greater push towards more efficient use of cash, as well as, a push towards improving shareholder returns. A lot of companies in Japan, especially banks, and have started to buy back more shares. Buybacks are about 6 trillion yen. It's up from 4.9 trillion yen in 2023. At the same time, in order to improve shareholder returns as well, more companies than before have announced an increase or have announced a dividend hike. 53% of companies in the Nikkei actually announced that they plan to raise dividends in the first half of 2024. And this number will most likely continue moving higher going forward. So for Japan, after the US elections, something interesting we saw is that the Nikkei 225 actually shot up after the US elections due to an appreciation in the USD JPY currency pair. This is because US Treasury yields increased because traders were positioning for Trump 2.0. And because of higher US yields, this caused the rate differential between Japan and the US to widen to its widest since July. And in the FX market, really a lot of depends on interest rate differentials. Uh, the currency with the higher interest rates tends to appreciate against the currency with the lower interest rates. And in the case of the USD JPY currency pair, a wider interest rate means that the dollar is appreciating while the yen is weakening. And a very unique relationship the investors should be aware of is the negative correlation between the Nikkei 225 and the USD JPY currency pair, because a weaker yen will benefit many of the export heavy Japanese companies such as Toyota as well as Uniqlo. But there is, of course, the risk that a weaker currency will increase imported inflation. And this is a rough graph showing the impact of interest rate differentials and the USD JPY currency pair. The white line is the yield gap between the US and Japan. You can see that sometime in November, the interest rate gap actually shot up, and this coincided with an increase in the USD JPY currency pair. So rate differentials are an important determinant of FX movements. So for 2025, our outlook, at least on USD JPY, is biased to the upside because we believe the US terminal rate will be higher because of Trump 2.0. The Fed will most likely be less willing to cut interest rates because his policies could potentially be inflationary. And we also expect a slower pace of BOJ normalization, meaning that they will take their time to gradually increase interest rates after what we saw in sometime in August, where a sudden normalization resulted in a huge market drawdown. So again, something else we noticed is that we believe Trump's election victory could change the flow of capital, especially in Japan and China. Uh, Specifically, if investors become more cautious towards China due to US tariffs, we do see a potential increase in fund flows towards Japan. And we actually started to notice this in the lead up to China's previous round of stimulus announcements before they announced the stimulus sometime in September. We saw that investors were actually starting to flow into Japan whenever they were bearish on China. So again, in event, in case we see any downside surprises in China, there is room or there is a scenario where investors may rotate their positions out of China and into Japan. So this is a technical analysis of the Nikkei 225. We see an ascending triangle pattern as well as a golden cross, and Fibonacci extension gives us a target level of about 43,000. Of course, towards the downside, we see it potentially going to about 37,000. So again, this is a table which summarizes our outlook for Japan. Something I like to highlight is that we are very positive on the value factor in Japan. Essentially, the value factor covers all the value stocks in Japan or stocks that are undervalued. And this is important because value tends to outperform growth, especially when interest rates are rising. This is because value stocks they have more consistent and predictable cash flows, and in an environment where interest rates are rising, cash flows that are more predictable become more valuable. And again, dividends per share for the topics is currently at its highest since 2005. Of course, yen fluctuations are a key risk factor, and this is why we think that the Wisdom Tree Japan Hedge Equity Fund, which is another ETF, will be also a good ETF to hedge against yen fluctuations. Again, you can see that the Topix Value Index for most of this year has outperformed the growth and so as the benchmark index. And this is because value stocks tend to pay higher dividends than growth peers. You can see the MSCI Japan Value Index has a dividend yield of about 3.5%, which is a lot higher than the growth index at about 1.5%. Other than that, in this year, sometime in the Q1 or Q2, we saw a lot of Japan's biggest banks, for example, Mizuho and Mitsubishi UFJ. They actually, raised their annual profit forecasts as well as, revealed plans to continue buying back shares. And this is all because of rising interest rates and a stock market that is, very in the green, especially for the banking sector. So moving on to our next country or region, I'll be talking about Asia ex Japan, and I will be, essentially summarizing this section. We are positive on Singapore equities and REITs. Of course, Singapore we provide very high dividend yields because of our allocation towards Singapore REITs, and the STI itself is very bank heavy. Our three major banks make up about 40 to 50% of the index, and the S-REITs and the banks will benefit if interest rates were to come down. And something very, very important I like to highlight is that Singapore stands out because as a country, we do not import very much from the US. So our trade deficit with the US is actually relatively low, at least compared to some of our Asian peers. And therefore, we believe that Singapore is actually at a very low risk of tariffs from US, and we see it as a more defensive play under tariff risk. Other than that, lower interest rates will improve the credit environment, and Singapore REITs will be able to continue growing because lower interest rates makes it easier for them to borrow, and they will be able to borrow more money, essentially to pursue more DPU accretive acquisitions, meaning that they pursue acquisitions that can increase their distributions per unit. And they can also do capital recycling, which is where the REITs will divest some of their unprofitable properties. And typically what they do is that they divest or they sell them at a price or at a value that is higher than their original purchase. So essentially they are making a profit when they sell them and when they purchase them, and they'll use the additional cash to pursue more DPU accretive acquisitions. So as REITs and Singapore equities, we have a very favorable outlook. Other than that, we also have a favorable outlook, especially on nearshoring and friendshoring destinations. This refers to some of our, as Southeast Asian neighbors. For example, Malaysia. Quite surprisingly, Malaysia has actually seen quite a big inflow of tech companies who are looking to, move or shift their data centers, especially in Penang. So there's a lot of opportunities as well in C, and these are some of the ETFs we believe that can best tap into this nearshoring and friendshoring theme. Now let's talk about Europe. It's also a market that's seen tremendous, traction in news. Europe has actually been seeing one of its worst years, at least relative to US and developed markets. This graph essentially is a ratio of the MSCI Europe index against the MSCI developed markets index. You can see that from a ratio perspective, it's essentially at its lowest since 2010, meaning that the MSCI Europe index is by far underperforming the developed markets index. We are also seeing slower revenue growth compared to US peers. You see this green line, it's the MSCI US sales projection, while the yellow line is the MSCI Europe sales projection. US peers are seeing more or greater revenue growth, and currently the most recent period or the most recent underperformance of Europe is about 2 standard deviations below the norm. So these are some of our macro themes. The European Central Bank, they cut rates for the fourth time this year, and markets are expecting them to cut faster than the Federal Reserve. So there's some form of policy divergence, and one possible benefit to that is that this has resulted in the euro being near a two-year low, and this weaker currency may potentially boost earnings, especially for exporters. This is important because Europe has actually a lot of internationally exposed stocks. For example, BMW, Mercedes, LVMH, companies in the auto and luxury industries are very sensitive to global trade, as well as China. As a region, they are also very highly dependent on revenue outside Europe. About only 40% of the revenue from the stock 600 is generated domestically. This means that 60% of revenue is generated outside of Europe. This shows us how dependent the region is on international trade. 26% of trade comes from the US, and 19% of sales comes from the APEC region. For Europe, we do see the bullish scenario happening, but this will most likely only happen if we were to see a ceasefire in Ukraine, and if US tariffs are more modest than expected. And we also see an upside surprise on Chinese stimulus. So for European equities, a weaker euro results in higher earnings, and this will be beneficial for European equities. We can see over here, which is the Euro's spot index, which is the white line. Typically, whenever the euro starts to depreciate or starts to weaken, we see that projections for Europe's European earnings starts to increase as well, which is the blue line. So a weaker currency could be one of the positive signs for Europe. However, if you guys have kept up with the news, Europe is actually currently undergoing a lot of political turmoil, especially in France and Germany. For France, they recently had a no confidence vote against their previous PM, and they were replaced by the country's fourth prime minister in a year. Imagine having four prime ministers in just 1 year. And a lot of their disagreements revolves around their budget, uh, where the previous budget aimed to bring down deficit by cutting spending and hiking taxes. So a lot of these disagreements within the budget, and what happened was that there was a no confidence vote where policymakers essentially voted for the current incumbent government to step down and resign. So ever since their snap election in June, the French Parliament has actually divided and stayed divided between three different groups, all with no absolute majority. So it's a worst case scenario when it comes to any form of government. It's a hung parliament. When we talk about hung parliament, this means that it's very unlikely for a single party to be able to push through a budget without facing significant resistance. And one of the key issues is public debt, as well as a very very huge fiscal deficit. This deficit grew after the government started to spend a lot of money just to keep the economy afloat during the pandemic. Recently as well, Moody's actually cut France's credit rating, and the French-German yield spreads are the highest ever since the 2012 debt crisis. So things are looking pretty bad in France, but not just that, things are also looking pretty bad in Germany. Both France and Germany are very important for Europe because Germany is the biggest economy in Europe, while France is the second biggest. And you can see from this news report I showed, which happened just about 13 hours ago, that Germany also saw a no confidence vote. So both incumbent governments in both countries were essentially dissolved, and what's left in place is a caretaker government. And most of the struggles are around the same thing. They struggle to finalize a budget because there's no majority party. Therefore, they struggle to push through the budget. And a lot of the budget issues also revolve around deficit, as well as some proposals by the previous government to reduce the deficit by cutting climate subsidies and social benefits. So of course, this met a lot of resistance. And right now for Germany, we expect to see early elections in next year in February 2023. But the key here is that even after the elections, for example, what we see in France, a new government, a majority government, may not even be formed, at least until all the parties agree and then they come to a coalition, and this could take up till April or May. So Germany could be without a majority government at least until April or May, and this is a very very, very big, bearish headwind, at least for us when it comes to European equities. So for European equities, we believe that the risk outweighs the reward. As I've mentioned, political turmoil in both the two biggest economies, France and Germany, as well as potential trade war with the US, tariffs, all negatives. Other than that, Europe as a whole has actually been losing in terms of international competitiveness to the US and China. And a lot of the reason is because they are lagging behind in innovation and productivity, especially in frontier technologies such as solar, EVs, and AI. Germany, for example, is still very over reliant on traditional industries like their auto industry and their industrial industry. Europe has also has a less mature, startup market, which is typically what's required to spur innovation and productivity. Instead, Europe is actually being bogged down by, a lot of regulations and a lot of bureaucracy. Germany typically has to see a lot and a lot of paperwork just to have a startup. Countries like Germany is also facing a decline in working age population, and most European countries are also facing very high energy costs due to missing Russian imports. Lastly, one last negative is that potentially higher defense spending due to geopolitical risks may also serve as a drag on economic growth. Of course, on the positive side of things, valuations are attractive, and a weaker euro may be a tailwind for equities. But overall, you can see that the risk for us far outweighs the reward. This is why we are bearish on European equities. Now let's move on to the UK. For the UK, we also saw a major shift in government. The Labour Party won power for the first time in over a decade. Thankfully, elections and political drama is in the rearview mirror. The budget has also been settled, and to put it And to summarize very quickly, the UK budget is emphasizes fiscal loosening. And what we mean by fiscal loosening is that the government is spending, which is the yellow or orange uh, histogram over here. They're spending more than what they're taking in through the form through taxes. And typically, this is supportive for equity markets. We also call it fiscal expansion. On the other hand, there is a potential headwind because corporate costs could increase due to a rise in employer national insurance contributions. So I'm not sure how much time we have left. I'll try to run through as quick as possible. Summarizing some of our key macro themes, we are actually pretty positive on UK within the European region. Firstly, political complications are in the rear view mirror. UK or the FTSE 100, the highest dividend yields globally. You can see in this chart over here that the FTSE 100 has a higher dividend yield than the S&P 500 and the Euro Stocks 50. Again, the earnings are also on a positive trajectory, and it's actually performing better than Europe as a whole. And also, UK stocks are also very attractively valued on an absolute and relative basis. When we talk about absolute basis, we typically refer to its valuation compared to its historical numbers. For example, at the bottom over here, the PE ratio is a lot lower than its 2020 highs. Other than that, the FTSE uh, UK stocks are also trading relatively cheaper compared to the MSCI World Index. And something important to note also is that a majority of the FTSE 100's constituents, in direct contrast to Europe, they generate a majority of their earnings and revenue outside the UK. And it's something to take note as well. And a key highlight of why we like the UK is that we see it as a tariff haven, not just because of their better political relationship with the US, but also because of their higher exposure to defensives. Again, the US has the US trade deficit with the UK is a lot lower than the EU, and the UK and the FTSE 100 has a very high exposure to the defensives sector. Consumer staples and healthcare make up about 30% of the index compared to the S&P 500 about 15%. And also 28% of the revenue in the UK is from the US. And this means that if the dollar gets stronger, they will be able to convert more of that revenue into more pounds. And because of all these characteristics, especially their high exposure to defensive sectors, data has shown that the FTSE 100 tends to serve as a shelter, especially during market turmoil. You see during the global financial crisis, the tech bubble, the Asian crisis, as well as inflation shock, the FTSE 100 has tend to outperform the MSCI All Country World Index, meaning that they outperform global equities during periods of market turmoil. And we expect this to happen again if geopolitical risks were to increase in 2025. So let's summarize our regional outlooks. For the international side of things, we are positive on the US because of all the things I mentioned. Again, we are neutral on China, but we do see pockets of opportunities in dividends, onshore A shares, as well as innovative sectors such as EVs and renewable energy. We are positive on Asia ex China, especially on Japanese equities, due to the corporate governance reforms that I mentioned. We also think that BOJ rate hikes will be mild and gradual, and therefore they will not pose a major risk to equity performance. Other Asian equities like India and Taiwan could also benefit. India from favorable demographics and its position as a friend-shoring destination, and Taiwan from AI. Singapore, as I mentioned, is a defensive play under tariff risk because we do not import that much from the US, so we are at pretty low risk of facing heavy tariffs from the US. Other than that, Malaysia is also a good AI play because the country has a lot of OSAT players. OSAT players refers to semiconductor companies that are in the back end of the ecosystem. OSAT stands for outsourced semiconductor assembly and testing. So those companies essentially assemble semiconductors and they test the semiconductors themselves. One such company is Inari Emerton. For Europe, as I mentioned, we are cautious of Europe x UK, but we are positive on the UK itself. So this is again our index targets for 2025, and yep, do feel free to take a photo before I proceed. So let's move on to our next section, which is positioning for 2025. We're talking about asset allocation. Most of the time, investors ask us what is the correct portfolio asset allocation. The answer is that this depends on what your problems are or what problems you are looking to solve. Are you looking for income? Are you looking for capital preservation, or are you looking for growth? Are you risk tolerant or are you risk averse? And is liquidity important to you? And all those answers to these questions will form your asset allocation. More recently this year, we see that certain assets have outperformed their counterparts. Stocks have outperformed bonds, US have outperformed international equities. So as a result, many investors they currently find themselves over allocated or overweighted to past winners while being underweight laggards. According to Bloomberg, the average allocation to ex-US equities is at a 12-month low. And we believe that this underweight is way too severe, especially amidst geopolitical uncertainty and elevated valuations in the US. But this does not mean that we should abandon the US, because US mega caps and the Magnificent Seven still have very, very strong tailwinds behind them. In other words, we believe that portfolios should remain balanced. And how do we be balanced? Investors can look to the bond market. More recently, we are seeing that the stock bond correlations have been falling, and this suggests to us that bonds can play a role when it comes to hedging your portfolios, because a negative correlation means that if equity markets were to drop down due to inflation going up in 2025, bonds can somewhat offset that decline. And what this means to us is that inflation is no longer a driver of financial markets, because historically bonds and stocks become the most correlated when inflation is higher than 3%. This is because higher inflation results in higher interest rates, and higher interest rates will of course weigh on equity market, but it also weigh on the bond market, because interest rates and bond prices have an inverse relationship. So how do we have a successful portfolio? I've shared this a couple of times, especially in my previous, I think, Bitcoin seminar a couple of weeks back. For a portfolio, it's very important that you don't just measure its performance through returns, because let's say you compare a 100% equity portfolio with a 100% bond portfolio. It's obvious that the full equity portfolio will outperform the bond portfolio because you are taking on more risk. So you need to adjust your returns according to your risk. And typically we do that by considering the Sharpe ratio. The Sharpe ratio essentially takes the return of your portfolio minus the risk-free rate, and then you divide it by the standard deviation of your portfolio. Standard deviation is essentially a measure of risk. And the key to increasing your Sharpe ratio and achieving a more successful portfolio is to reduce your portfolio standard deviation by adding in uncorrelated or low correlation assets. And this is why we typically say diversification is the key to a successful portfolio. So the golden question: how do we achieve higher returns while at the same time having lower correlations across different assets? Let's look for different alternatives. Typically, what analysts like me do is that we look at a risk return spectrum and measure and compare all the different asset classes. And right off the bat, you can see that right at the very top right hand corner, we have a particular asset class that generates very, very high returns, but it's also considered pretty risky because standard deviation is very high. And this asset class is Bitcoin or cryptocurrency. So their risk reward profile is at the far right of the risk reward spectrum. Uh, However, this is actually can be viewed positively because it can improve your portfolio's risk reward profile. More on that later on. So alternatives like commodities, real asset, hedge funds, private capital, the three of them are, most of the time are inaccessible for retail investors. But commodities and cryptocurrencies, they can improve your portfolio's Sharpe ratio. And this is more important because equities, with valuations at all-time highs, could see, lower future returns. Upside may be limited. At the same time, for the bond market, because interest rates are coming down, your income opportunities may be lower as well. So we believe that the traditional 60-40 portfolio may be better reformed into one that includes alternatives like commodities, cryptocurrencies, and other things of that nature. So rather than 60-40, a 50-30-20 or 60-30-10 portfolio, for example, with the 10-20% allocation split among alternatives like commodities or cryptocurrencies. Such a portfolio can maximize your Sharpe ratio by increasing returns, while at the same time minimizing your portfolio's risk. So now the question sometimes people ask is, where does Bitcoin fit in my portfolio? Our research or my research has shown that Bitcoin has historically had a low to moderate correlation to stocks and bonds, although this varies over time. So simulating a portfolio and assuming a 5% allocation in that particular portfolio, and in terms of SGD, and after benchmarking its performance against the S&P 500 ETF, we see that the Sharpe ratio of our portfolio, of our simulated portfolio, actually improves compared to the S&P 500 ETF on both a 3-month, 6-month, and year-to-date basis. You can see our portfolio Sharpe ratio is at 4.1, and the S&P 500 ETF is at a Sharpe ratio of 3.39. And this is very similar to what we see in gold as well, and which is why we highly recommend adding gold and Bitcoin ETFs into your portfolio. Gold also does much of the same. It also helps improves your portfolio's risk reward profile because gold, other than Bitcoin, can be seen as an asset class that reduces your portfolio's risk, while on the other hand, Bitcoin improves your portfolio's returns. So now the question is, how much Bitcoin should I allocate to my portfolio? And if you've attended my Bitcoin seminar in 28 November, you would know of this. Our research shows that in a 60-40 portfolio, the more Bitcoin you add, your Sharpe ratio will initially increase, but once Bitcoin makes up more than 10% of your portfolio, we see that the return or risk ratio starts to decrease. You can see at 0%, the return risk ratio is at 0.25, at 5% is at 0.25, and at 20% it starts to level off at 0.23. So this means that we believe Bitcoin can have an allocation probably about 5 to 10% in your portfolio. And much of the same principles applies to gold as well. So finally, heading into the final section of today's webinar, I'll talk about our top 5 favorite plays heading into 2025. Firstly, our first favorite play will be on Trump trades. As we've predicted in some of our articles, financials, industrials, and energy, consumer discretionary are some of the best performing sectors after the US elections. This is a table of different ETFs that we expect to benefit from Trump 2.0. For example, we have defense ETFs. They will likely see tailwinds from higher defense spending under Trump 2.0. We have the US Aerospace and Defense ETF. We have the SPDR S&P Aerospace and Defense ETF. Small caps are also very well positioned to benefit from tax cuts as well as domestic protectionism. Small caps will also benefit from lower interest rates, especially because small cap companies they tend to have a higher debt load compared to large cap companies. So lower interest rates and lower borrowing costs are very important for small caps as well. Of course, we have crypto ETFs, which is benefiting from Trump 2.0 and an administration that is more embracing of crypto. So before we proceed, feel free to take a photo of this table as well. So other than that, we also another major theme that we like will be the tech sector and AI 2.0, and we see opportunities outside of semiconductors, especially in AI adopters. It could be robotics, automated driving, data centers, and energy infrastructure. These are some ETFs that we like to tap onto the AI theme, as well as looking beyond semiconductors. For example, we have the Global X Data Center and Digital Infrastructure ETF, which, like its name suggests, it focuses on data centers and digital infrastructure. Again, just sharing this table for one last time. This is a broad set of all the different AI beneficiaries uh, in the AI ecosystem. We have different segments and different companies that benefit from this overarching theme of AI. So our third theme that we like is regional diversification. We've mentioned the importance of diversification, and we like Asia x Japan. In particular, we like Japan value and currency hedged Japan. And I mentioned these two ETFs previously, and we like value because it tends to outperform when interest rates are rising, and the currency hedged ETF will help protect us against fluctuations in the FX market. We also like Singapore equities and S-REITs. We like Singapore, especially because it has a low trade deficit with the US. S-REITs and banks in Singapore will also benefit from lower interest rates. Nearshoring and friendshoring destinations can benefit ETFs like the Southeast Asia plus Tech Index ETF, and more recently, ETF that was recently launched, I think just last week, we have the Lion China Merchants Emerging Asia Select Index ETF, and it focuses on 5 countries: Malaysia, Indonesia, Thailand, India, and the US. So all these countries, all these ETFs could see tailwinds from this trend of reshoring, nearshoring, and friendshoring. Our fourth play that we like would be safe havens. This includes precious metals like gold, which I mentioned can protect you against geopolitical risk. On the other hand, silver can be seen as a leveraged play on gold because silver will outperform gold whenever the economy is doing well. Because silver sees a lot more industrial and commercial uses. Silver is actually a very important material when it comes to EV photovoltaic cells. Uh, Essentially, they are cells which are vital to producing solar panels, as well as converting sunlight to electricity. Our second safe haven play will be bonds. Again, bonds, they're probably quite a complicated concept, especially for investors who are more familiar with equity investing. So in that case, there are bonds which track, aggregate bond indexes, which means they cover all the different types of bonds, T-bills, corporates, mortgage-backed, different maturities, and they are ideal for hands-off investors. We have the Singapore Bond Index Fund, the Vanguard Total Bond Market ETF. For more investors who are more familiar with bonds, you can take a look at longer durations because longer durations they benefit the most when interest rates come down. And in this case, we have the popular TLT, which is the 20 plus year treasury bond ETF. Uh, on the other hand, shorter durations will provide you with greater protection against interest rate risk. And we have the 1 to 3 month T-bill ETF. Of course, corporate bonds, such as the MBH ETF over here, they provide you with a lot higher yields, but you need to carefully assess the credit quality of the companies in the portfolio. Lastly, the last theme that we like, as we've mentioned, is to somehow improve your portfolio through alternatives. How? We have three possible options. First, niche options. I've present. Uh, I think if any of you have attended, I have a previous webinar regarding options, and options provide another way to perform better during in different market environments. It's quite unique. Global X has a Nasdaq 100 covered call ETF, where essentially they write call options on the Nasdaq 100, so you get to participate in the equity upside while at the same time receiving premiums from the covered calls or from writing the call options. However, your upside potential is capped if the market rallies beyond a certain strike price. So, typically covered calls perform the best when markets are sideways so that you can participate in the upside while getting regular premiums. We also have tips or treasury inflation protected securities. You can look to them, look at them if you're afraid of inflation risk. Lastly, we also have leveraged and inverse ETFs, which will allow traders to magnify returns during market rallies or market declines. But we stress and highlight that L&I ETFs, they are typically meant to be held as an intraday investment. Typically, you buy and sell them on the same day itself, and it's not to be used as a buy and hold investment because of the compounding effect, where expenses will compound and your declines or your returns will decompound as well. So it's important to keep that in mind if you are interested in L&I ETFs. For some examples, we have the Ultra Pro Short Triple Q. Essentially, the ETF will give you 3 times the inverse returns of the Nasdaq. So if the Nasdaq returns about 30%, this ETF will drop by 90%. On the other hand, we have the Ultra Pro QQQ, which is 3 times the Nasdaq, and we even have specific semiconductor sector ETFs as well. The SOXL, uh, it gives you essentially 3 times the returns of this semiconductor sector. So with that, we've come to the end of today's webinar. Apologize if it was taking a little bit too long. I hope you guys have learned something new today. Thank you. And if you guys have any questions, do feel free to contact me through the email over here. And yep, let's address any of the questions that you guys may have.
Hey Danish, can I just do a quick check? If you can see the questions, you should be able to on your end.
Yep, let me address the questions and pick it out.
Okay.
Okay,
Members of the audience, if you have any questions, you can type them in the question box. Danish is looking through them right now.
I think there's a question from Steve Fu who said he asked, Nvidia has been going through a pullback these few days. Is it still too high to enter? That's a very good question. However, I think it's not still too high to enter. I've never shared it here actually, but we do actually have a target price of Nvidia. Currently it's about 160. So as long as it's below this target price, we still think it's a good time to enter into Nvidia. So and again, I don't think it will ever be too high because the future prospects of Nvidia is very, very good. So I think it will be better to see any pullback as a good entry opportunity. So I think there's another question from Elim, which is, oh, it's Elim from the Star. Okay, so her question asking, can you share with us what are some of the stocks or sectors in Malaysia that would stand to benefit from the tourism thematic from Visit Malaysia 2026? So I think she has a couple of questions, but I'll just address this. She's referring to what are some of the specific stocks or sectors in Malaysia that will benefit from an increase in tourism in Malaysia. So just right off my mind, there's one particular stock that stands out, and it's Genting Malaysia. Some of you guys I believe, especially if you're Singaporeans, you may have traveled to Genting itself. I think the stock right now, the last time I checked, in terms of valuations, it's still below, it's still quite cheap on an absolute basis, meaning it's below its historical averages. And other than that, um, Genting Malaysia as well will definitely be one of the biggest beneficiaries, especially from increase in tourism. Of course, other than that, there are other companies, consumer companies like Pardini, as well can benefit from an increase in tourism. So I hope it answered your question, Elim. So maybe we'll take about one or two more questions. I think there's a question from Ravi who is asking which area do you see most value if someone has to enter the market now? Well, that's a good question. I think in terms of purely from a value perspective, I think personally I'm actually favoring the UK side of the market because of all the factors I've mentioned. Their valuations they are being priced somewhat like European equities, despite having very different fundamentals. Like I mentioned, political complications in the Europe. Uh, there are political complications in Europe, while in UK, the election is behind us. While at the same time, the budget has actually went through. It has actually been published and sent out to the government, to the public, compared to in France and Germany. So UK is being priced like Europe, despite having pretty good growth prospects. As I mentioned, the earnings trajectory is better than Europe, and other than that, I think it's a very good defensive play because, especially in 2025, because of tariff risks. So yes, I think that's probably my answer to your question. If you are, purely a value investor, the UK will probably be one of the better areas where that I would say that I would recommend you to enter in 2025. Okay, let's take one last question. So I think there's one question from Motley who is asking whether I think US stocks are in a bubble and whether they may be due for a correction like we saw in 2022 or even a dot-com crash. Thank you for. Okay, so I think I didn't mention it previously, but one big difference between a dot-com crash and right now is that a lot of the growth in tech or big tech companies back then in during the dot-com bubble, it was driven by debt. Companies took up a lot of debt in order to grow their companies. However, right now what we are seeing is that companies are growing through not through debt but through free cash flows, through their existing cash piles. So it's a very different environment. And to answer your question directly, I think that US stocks aren't really in a bubble. In fact, I think our target for 2025 for US equities, especially for the S&P 500, is for more upside, maybe about 6,500. Yeah. So I think yes, that'll be the last question I answer. Sri, do you want to take it from here?
Yes, thank you so much, Danish. Thank you for taking time to answer so many questions and for covering so many different extensive markets as well, and walking us through your views and thoughts about how 2025 is going to pan out. The conversation does not have to end here. If you have more questions, you can send them to us via the email that Danish provided earlier, or you can just reply to our follow-up email, which we will send with a link to this webinar recording so you can revise what was covered here and be ready for 2025. Okay, so if you have any other questions, keep them coming. And thank you for being a wonderful and really participative audience today. Here's to a very pleasant Christmas and a great 2025 ahead. Thank you so much, members of the audience, and thank you, Danish. Have a great night and a great trading week ahead.
Thank you.